Good morning, everyone. Thank you for being here. I'm Nnema Byrd. I'm the portfolio manager of the STANLIB Africa Direct Property Development Fund, which is an African-focused private equity fund that looks to deploy capital in the rest of Africa, primarily in East and West Africa. And we focus on the development of office and retail centers in key markets.
Okay, wow. Okay, so you're the money bags. Is that what we got the money bags over here? Well, that's great, thank you. That's wonderful. All right, Tim, you want to maybe do...
Hi, so I'm Tim Harlech-Jones, Business Development Director at Bentel Socials International. We typically master planners, architects, and interior designers, amongst other things, store planners, etc. But I suppose our core focus is very much in the design environment. We've been around for about 60 years, so it's one of the more long-standing firms in South Africa, based in South Africa. We do have an office in India, quite a large office. But I suppose our focus is Africa, and that's where I suppose the conversation is going to go today. We are covering a number of asset classes between retail, hospitality, residential, as well as typically mixed-use developments, and I'll talk through a lot of that later as we go.
Great, and then to Vere.
I am Vere Shaba, and I'm a green building engineer for Green Design, which is a part of Shaba Africa. So we assist in terms of partnering with property owners and developers and consultants to have sustainable buildings. And what a sustainable building would be one that uses low energy, low water, and low waste. So we've been working in the industry for 10 years, traveled to 12 African countries to assist them in terms of getting green in place. And within the next 2 months, we will be registering as well in Abidjan and Maputo, because we found that there's quite a need for green buildings in Lusophone and Francophone Africa. But a lot of the technology that they're getting is really not from within the African context. So that's what we do as green building consultants. So that's the angle that I'll be coming from, is really green. What Andrew didn't mention is that the Radisson Red actually was a 5-star Green Star certified hotel. And it still came within budget and has good returns. So a lot of the times the misconception that green is more expensive is not really true.
Great. Kim, do you want to introduce yourself?
Yes, hello. My name is Kim Irmler. I'm Development Director for Accor Hotels. We are one of the bigger hotel operators globally, with about almost 5,000 hotels across the globe. And we've recently, well, not so recently anymore, about 2.5 years ago, established an office here in Johannesburg, really focusing on Sub-Saharan Africa. And we, at the moment, have around 160 hotels across Africa. And I think in terms of a brand, we have about 38 hospitality brand or hospitality-related brands, of which probably around 30 are actual hotel brands, from any kind of segment through all segments, from budget through to high-end luxury, from traditional across to lifestyle and branded residential. And we have a very keen focus on becoming far stronger in the sub-Saharan African market. So I look after various regions. My prime focus is Southern Africa and Kenya, and always keen on looking at new sites to develop new hotels.
Great, fantastic. Could you just pass the microphone, Tim? Let's starting on my left-hand side with Nnema. And maybe you could just tell us a little bit about what is it that you're looking for in terms, you mentioned obviously in particular in the office sector, I didn't hear hospitality there in terms of investment. Maybe you can tell us, what is it that you're looking for throughout Africa? I mean, what is the criteria? Is it just the standard way of we're going to finance this? What are the kind of things that you would look at? What's the criteria to look at before investing, first of all, in Africa and in terms of the requirement for finance? How does it work?
Sure. So, of course, the first thing that is key to us is location. So we have certain target countries that we're looking at, and these countries have proven themselves in terms of economic growth.
Would you share those countries? Or?
Yes. So we are primarily looking in East Africa at Kenya and Uganda.
Right.
Historically, the growth rates of these countries, GDP growth rates have topped up 6%, and we're looking at possibly 7% going into 2019.
Wow.
For Kenya at least. And then in West Africa, we had looked at the Anglophone countries, so Ghana and Nigeria. Obviously, just the language issue and some semblance of commonality with the legal system, etc., made those countries quite attractive for us, in addition to the size of those economies and the GDP growth. Now, as previous speakers have mentioned, the 2014 to 2016-17 recession had a detrimental impact on West Africa, particularly on the Nigerian economy. The sharp commodity slump that was seen, as well as the currency crisis and illiquidity crisis, kind of meant that we took a back seat to those markets. So obviously this points to the fact that the macro conditions in those markets are key, and that's where we start in our top-down analysis. We start at the macro level. What are the major countries that we're looking at, or the regions? And then we kind of delve down into specific cities, these primary cities that we're looking at, or secondary cities, and then the nodes within those cities, the specific sites within those areas. And what we're seeing now is, in the earlier days of real estate investing, when it was, first people to the market, the Actis and R&D Westports, they were building the first malls, the first major commercial buildings in these major cities like Accor and Lagos. But now these markets are, there's an oversupply of product in these markets. And so what we're seeing is that we're actually interested in looking at suburban areas outside of these major cities. So not necessarily being in the core of the city. So while we're looking at the West African markets, we're looking at centers outside of Accra, where there was a significant population growth, and areas or locations in secondary cities that had strong economic fundamentals. We're also seeing an interest in specialized retail. So whereas previously the initial investors were looking at putting up large regional centers, we're actually finding that neighborhood centers, community centers, are actually more profitable in the long run, and they're more accessible to the community. So those are kind of areas that we're looking at from macro, and then product type. In terms of other softer qualitative aspects, we look for strong sponsorship. So in our projects, we typically would want to go in with a local sponsor. This local sponsor can come in as a landowner and contribute the land to a joint venture, and we come in and put in the additional capital for vertical construction. We find that working with a local sponsor, whereas there might be headaches and issues along the way, over the long term, is more beneficial because you have someone that's on the ground, someone that's knowledgeable about the market, and knows the way in terms of navigating the municipalities, political landscape, etc. So we tend to look for those types of projects and investment opportunities with strong local sponsorship. What we're finding now in the market is that there's been a development of local real estate developers. So, when Actis first went in and put their first mall in Accra, and in Nigeria, they worked with local landowners. These entities have now become, reputable real estate development companies, along with other specialized real estate companies that we're seeing in East Africa, etc. So there has been that development of homegrown talent that we're seeing, which just bodes well for the market. In terms of financing aspects, we're obviously looking for returns that are, in the low 20%, so low 20% IRRs. Of course, our investments are leveraged, so that helps to push up the IRRs. We look for debt of about 50% of the total development cost, and we're looking at debt interest rates that are lower than the yields that we anticipate on these projects in order to benefit from that positive leverage aspect.
Great. So the sectors you mentioned again that you're targeting?
Office and retail.
Office and retail. So
primarily retail. Our projects have currently are in retail, but we have looked at office.
Yeah, so those developers with a plan to break into those, we've got a financier. You know the criteria. It's there. It's been laid out. It's on the table for you. Thank you very much, Nnema. Okay, Tim. Tell us, just from an architectural design perspective, where's your focus? Where is it? And also outside of Africa, I mean South Africa, yeah?
So as I said before, we've been established here in South Africa for quite some time, and I think we were one of the first people to go outside of our borders. And you mentioned some of the first developments with Actis and etc. We started off with the Palms development in Lagos. Accor Mall, etc., etc. So we've been focusing on Africa for quite some time. I suppose if I look at our the work that we're doing currently, it's very much hospitality focused, and I think that was picked up by Malcolm even earlier, where there's quite a trend and a focus on hospitality, and I think Kim will pick up on that a bit later. And I don't want to talk too much about that, but what I do want to pick up is mixed-use developments, which I see quite a number of potential projects and projects we're currently working on where it's not just about one particular asset class, and we talked about retail, we talked about office, but I think it's all about putting that all together into one basket and looking at how we develop these new nodes that are able to add vibrancy to a city. And I think if I look at the type of work we're doing, the project where we're doing it, very much East Africa seems to be quite it just happened to be a core focus of us at this time. Ethiopia, funny enough, we've got two projects there, one being quite a large mixed-use development, but it is boutique retail. We're not talking about large centres, and I think you picked up on that as well, where the days of the 30,000, 40,000, which in African standards is very much more a super regional or regional centre, it's now going towards more neighbourhood 15, 10,000 square metres centres. And that's what we're finding also, that the projects that we're working on. And I think that's also the focus in terms of more suburban areas. So you've got a take-up in terms of the urban areas, the city, the CBD, where the shopping centres have been built. If you look at Nairobi at the moment, you've got Garden City, you've got Two Rivers, the Hub, the Karen. So all those bigger centres have now, I suppose, not saturated the market more than it is created market, but there's opportunity in the outlying areas, secondary cities, secondary towns, but also more suburban areas, more convenience centres. But just picking up on the mixed-use theme again, I think there's quite a big sort of focus on this because of traffic congestion in cities. A lot of the developers that we're working with want to develop something where they're creating a neighborhood, creating a community. There's also the price of land. That's also quite an important factor to consider. If you think about South Africa, the land has got nothing on what I've seen in Lagos and Nairobi, etc., where the cost of land are, exorbitant to say the least. So it's how you use your asset to develop something which allows on different asset classes to get your profits, look at your profits, and I think that's a key contributor to the mixed-use developments that we're doing at the moment. And it also creates a sort of live-work-play environment. There's a couple of examples in South Africa. You look at Waterfall City, Marazaj is a classic example, but I think looking at Africa, we started off with a development called Levy Junction many years ago, and that was sort of one of the first developments where it had hospitality, office, and retail. But I think that's gone further, and I think now it's more consolidated, where you've actually got almost like a horizontal play of retail, office, residential, or hospitality together in a more concentrated environment. So that's definitely a trend that I'm seeing in terms of ourselves, designers, architects on the continent, and the type of business and the type of projects that we're doing at present. I also think that it's important from a designer's perspective to actually see the negative space between the buildings as something quite important. Because a lot of the time we talk about the building, which is like the positive, it's the urban, it's the fabric, it's the solid, it's the brick, it's the mortar. But I think there's also something to be said between the spaces, between the buildings, and how you develop that, the corridors between the buildings, the piazza. And that goes back to a lot of the another theme that is coming up internationally called retailtainment. which I think is something that we're looking at quite closely, because developers are actually bringing that into the development. They might not be specifically looking at it from an international perspective, which I think is very American and is trying to redevelop shopping centres that potentially are losing tenants or have lost tenants to online business.
So just elaborate a little bit on the retail tenant, the concept.
Yeah, so typically, and I'm talking about African context, is bring it locally, bring it African. I think the developers are all talking about creating a centerpiece in the development, whether it's a piazza, an amphitheater, whatever it might be, to allow activity to happen, to allow a gallery to pop up, to allow an event to happen, a market. So it brings something. It's a changing environment in the retail space where shoppers are wanting something completely different. It's about creating an environment where people want to come back to. And I think that's part of the consolidated word being retail and entertainment. It's about bringing entertainment into retail. And not only just the mixed-use environment, but also in the retail environment. So those are sort of two themes that I think I'm picking up, and I can see going forward. I think there's definitely a huge opportunity in.
Fantastic. Great. Vere, so you are engineering consulting firm specializing obviously in the green space. You're also operating in various countries throughout Africa. Maybe you want to share where you are doing it, and maybe just share what are the trends you're seeing in those areas. I mean, is it different from outside of South Africa, rest of the world? Are there unique sort of African concepts or trends that are happening in those areas?
I think speaking from a designer perspective, it's exactly what you had said as well, in terms of there's a lot of mixed use that's starting to come out. And I think that's mostly because Lagos, for instance, just getting to the airport, traffic is crazy, even if you're about 5 kilometers away. And so if you have a mixed-use precinct, we found that a lot of people are starting to go for that perspective. So we found that quite a bit in terms of the trends that we're working on. And then another thing that we've just noticed in terms of new buildings is, so it's the mixed use, but it's also the use of smart technology and prop tech. And that's something that a lot of us are still trying to get used to, but we found that can decrease in terms of your project costs, and it can increase your project quality, as well as the scope as well. So we're finding that a lot more property developers are saying, let's not just model it on CAD, for instance, let's do it on BIM, which is building information modeling. And from that, you can actually do 5D, which looks at cost and program. So we're finding that that's being used quite a bit as well in terms of the new buildings. And then a lot of our work that we're finding is that a lot of the existing buildings, because that's our largest building stock, is actually existing buildings. And people are saying, what do we do now with our existing building stock? Do we dispose of it or do we keep it? So we found that a lot of people are repurposing buildings across the continent. And how they're doing that is through green interiors, in the sense of making sure that the spaces are comfortable for everyone inside the building. So we're finding a lot of repurposing the facade, repurposing the internal, and just with the recession that happened, there was a very high vacancy rate. And so what we found is that suddenly tenants were downsizing or just getting out of buildings. I mean, if you look now, there's a lot of agile working spaces. For instance, WeWork coming into South Africa is starting to change the concept of what an office is, because suddenly there's telecommuting. And so we found that a lot of people are saying, how do we repurpose our space? But also, how do we become more competitive versus the person who's next to us? And so that's some of the trends that we've been picking up in terms of existing buildings is repurposing, it's green interiors, and also it's just the use of technology. So smart technology and building information modeling, just from an engineering and green perspective.
Right. So tell me, the areas you're operating on, the very similar countries, African countries at the rest, or do you want to maybe just talk about some of those? So
the areas that we currently operate in is in Mozambique. We found that there is a lot going on in Mozambique, just from a engineering sustainability perspective in Mozambique. I won't go into the technicals, but they currently just use DX-split units, and now they're saying, how do we become more sustainable? What other technology can we start using in the different office spaces, specifically the multinationals, the internationals coming in? because they're used to a particular standard. So we're working in Mozambique. We're also now starting to work in Ivory Coast, so in Abidjan. A lot of that is residential. So we're seeing a lot more high-rise residential coming up in Francophone Africa. So that's also something that is coming up quite a bit and mixes with mixed use. So you have the ground floor has got retail, you maybe have office space, and then it's the residential. So we're seeing quite a bit of that. And then just the third one is Zambia. So there's a lot of hospitality projects that are coming up in Zambia. And not just Lusaka, but like the Zambezi River and Lake Tanganyika, so the Zambia side of Lake Tanganyika. So that's also coming up quite a bit in terms of hospitality. And those are some of the projects that we're working on outside of South Africa. Within South Africa, a lot of it is office, but what I've seen is a lot of it is repurposing office spaces. So people are downsizing or people are moving into other spaces, and it's repurposing that. That's what we do quite a bit in South Africa.
Excellent. Great. Thank you, Kim. If you could maybe just tell us about the Accor group, in terms of your rollout. And I know you've got most of your peers and your competitors sitting here. In fact, there's quite a large... Oh, did he walk out? So you can share some. So maybe you can tell us, what is your business? I mean, the business of owning hotels, right? You tell us maybe about your business model, where you're operating, where you're rolling out, and what trends are you seeing?
So yeah, I think Accor Hotels was probably a bit of a latecomer when it comes to going asset light, as what we call it in the hotel industry. I think we did own some of our properties. I think we owned about 900 of our properties. And we have recently gone through a disposal of a certain percentage of those properties and gone a similar route as Hilton has or Marriott, where we don't continue to actually own our assets, and we purely focus on management and franchise agreement globally. So our business model is particularly to sign management agreements or franchise agreements. I think throughout Africa we sign probably more management agreements than we have franchise agreements, simply also because we like to maintain control of our brands and to be able to ensure that they are managed in line with what our brand standards are, and that the customer can
so would that be on the franchise side or on the management side?
The management side.
On the management side.
Yeah. So the majority is a management agreement. Because I think that there is still throughout, and that doesn't necessarily qualify for South Africa, but throughout Sub-Saharan Africa, we still see that there's a lack of skills in terms of managing hotels. So I think that is up and coming, and as this grows, our model may change or our approach may change to Sub-Saharan Africa. But at this stage, our main focus is into management agreements. So, I mean, obviously being Accor, having a very strong, we're listed in Paris, it was originated in Paris, we have a very strong tie or link to Francophone Africa, hence we're very strong we have a very strong presence in Francophone Africa, and we're now trying to build on Sub-Saharan Africa and Anglophone African countries. So with the newly established office here in South Africa, we are focusing mainly on primary cities throughout Sub-Saharan Africa. So I think the top 5 are probably Cape Town, Johannesburg, Nairobi, Lagos, and Accra. I mean, just to add to this, Accor, while it has gone the asset light route, it may be confusing for a few, but we have established, or in partnership with Qatar Hospitality, we have established a private equity fund, which is called Casada. The equity fund is primarily focusing on hotel investments in Sub-Saharan Africa that are directly linked to the Accor brands. So they're all going to be managed by Accor. It is because we have realized that there is a lack of finance at certain levels available to actually push forward these developments. And hence we take a very strong, keen interest in Sub-Saharan Africa, and we've come with a $500 million private equity fund with leverage. It will probably go up to $1 billion. They're focusing on the same key areas as our development team is.
can you maybe just elaborate how you're differentiating yourself from your competitors? We saw, obviously, your competitor up there. Are you doing something? Is there something, I mean, without sort of giving away too much? I mean, we saw Andrew's presentation specifically in the Radisson group, what they're doing, and is there? And I think Tim, you could probably help answer that too, because you're the guy that puts the whole plans and conceptual. So maybe I directed at you as well. Do you want to maybe just share something?
I think from a design perspective, Tim is probably better geared up to answer this question.
That's
But
in general.
I think in general, I mean, there's various things. I mean, obviously, we have a very broad array of brands that we have available that we can really, where others may find this confusing, it actually does make sense once you actually delve into it.
Okay.
Because it's very much geared nowadays. We want sort of like standardized customization, if you want to call it that,
yes.
where people want to have something different, but they do want to, they have certain expectations of certain brands. So they want certain nuances to be there, but they still want to have sort of a core DNA to still be sort of similar and to know what they're expecting when they're going to stay at a specific hotel.
And what are those brands? What are those brands? Do you want to maybe just tell us a few of them?
Well, I mean, you have the pure standardization, which we call the traditional hotels, which is our core start out, which is sort of the Ibis and the Novotel. They're very, very standardized. It's cookie cutter. You know exactly what you're getting in terms of room sizes. I mean, it's very quick implementation. Whereas when you go further towards, your collection or your lifestyle or even a bit more luxury, it does nuance slightly. And I think one of the big drives that Accor has done in the last 2 to 3 years is we've acquired numerous brands globally, and we've gone a very strong drive into the lifestyle segment. So it's similar as what Andrew alluded to earlier. We have brands such as Mama Shelter or Tribe that are really geared initially with a focus on the millennial customers or the future traveler, which is going to be your future in the next 20 years, and you want to kind of canvas that market right from the start, where you're going definitely more efficient design in terms of your food and beverage concepts. It's not anymore sort of the very separated restaurant from your lobby, where now the lobby gets integrated sort of with your restaurant and it's all flowing spaces. I mean, I'm sure that you agree that that is sort of the drive that most of the brands are going towards. For example, the Mama Shelter is we call it, it's more a restaurant with rooms rather than a hotel with a restaurant, where a lot of people actually don't realize that there's a hotel on top of the property. So you actually, with that concept, for example, getting in the local crowds to actually have lunch and dinner or Sunday brunches at the hotel, and you have the international, the traveler coming from outside staying at the hotel, and you're kind of creating a vibe and an experience, which again also goes into that, what do you call it? Retailtainment. Where you're creating, sort of a vibe where people really want to come back to and stay at. Yeah.
But I can just pick up on talking about the brands. I mean, as a designer, we're working across the brands, between your competitors, etc. And what we find is that it's very clear about what the brands want in terms of relationships, gross per square meter, ratios, efficiencies. So when we're designing, we're quite clear about where the brand sits, because depending on what segment it sits in, whether it's a budget, mid-scale, mid-market, upscale, as it goes up to luxury, ultra-luxury, they all have different requirements in terms of facilities. Now, you also don't want to, as an investor or developer, you don't want to be putting more money in having a 50 square meter room when you're doing a 3-star hotel. So those are quite clear. We've got to be quite clear when we design that it's working on particular efficiency ratios that work to the particular brand. And you can see from Andrew's earlier presentation where you have all the market segments, and for instance the Radisson where it sits, it's a 21 square meter room, but it almost sits in a sort of upper mid-scale, upper upscale type segment. And I think that's where things are going, where smaller room sizes, but also you mentioned about the public areas. Now that's important because there's a lot of integration that happens in the public areas, and a lot of the brands are calling it a great room concept. Now, a great room being, it's all amalgamated together, the all-day dining, the lobby, the bar, it's all one big space, but it's how you segment that, how you break it up. You have screens, you create little private areas, you create interactive areas. That's what people are wanting, it's about this entertainment value. People want experiences. People want something different now. And this is, again, talking about the theme of today being trends. And I see that coming through internationally through the brands, and then going into the African continent, because that's where the designs and the buildings are happening.
I think just to add to that, I think yes, I mean rooms are important because but you want to have a good bed, you want to have a good shower. So I think those are the key things in development and in design. But I think the way the future is going, or at least the younger crowd is going, is they want to come out, they want to go into the lobby, they want to spend time in the lobby. I mean, you look at it, the co-working spaces, people want to be in a communal space. They don't necessarily want to pull back and sit in their room to sit on their laptop. They're happy to actually be in the public space. So I think that's where sort of the trends are also shifting towards, that you're definitely going towards the public spaces. And I think where South Africa still was, historically, obviously the history of South Africa, we're very inward looking, whereas I think a lot of the hotel brands are definitely more outward looking and opening up, with open spaces to allow for the public to actually kind of roam through and come into the public areas.
There is an opportunity for the green building industry. I mean, to get the hospitality, to make them more green. Is there something that you've maybe spotted, or something that you think that they could implement in terms of the trends?
I think what's interesting is that Africa is not an aging population. So I sit on this panel as a millennial, so I'm probably a case study of it. I'm not too much millennial, I just made it. But what I would just say is that because of that, agility is so important in terms of agile spaces. So what they were talking about, everything needs to flow together. People no longer want to be in cellular spaces. You want to almost have cross-pollination of ideas, and that doesn't happen if it's very cellular. So that applies for hospitality, it applies for office, it applies for even residential. More and more people just want to have that cross-pollination. And then just from a green perspective, because now there's more access to information, if you look at things like plastic, something really small, people are very much, it can actually have an impact on whether or not someone would choose one hotel over the other. So even when I saw the Radisson Red, they said they're organic, low waste, like the beer, we're looking at vegan beer and vegan wine. I mean, I didn't even know that existed. But people are starting to ask about these things. They go into a space and they're like, what's your policy on water? What's your policy on energy? Do I actually, because to be honest, from someone who is an engineer, all hotels are the same. We start looking at price points. If price points is the same, the next decision-making process is those kind of aspects. Just in terms of people are more conscious, there's more access to information, and there's also more choice. So what differentiates the hotels, what differentiates the offices, what differentiates the residential? One of the concepts that is really becoming a big thing is what is called the circular economy, and looking at things like industrial symbiosis, and also looking at things like biophilic design. But the idea of just, especially with mixed use, how does one's output becomes another's input? And so a lot of people are starting to look at circular economy as well, in terms of just how you design the building. And so that's, I think the main thing is really just from a hospitality perspective, it's what is the policy on waste? That's a very simple thing to look at. What is the waste policy? At the end of the day, waste is a sign of an inefficiency. So if you're decreasing your waste, you're also decreasing your operational expenses anyway. And so also energy and water, if you have a low occupancy in your building, if you have systems in place that look at decreasing energy consumption, decreasing water, especially water consumption. I can tell you now as millennials, if you're in a hotel, you're going to shower for 30 minutes, like this, as if you're somewhere else. And so it's almost like, how do you make sure that your building is decreasing operational expenses, especially in hospitality and office as well. So there's a lot of potential. We found that we had clients in Nairobi. They gave us their portfolio of hotels, existing buildings. What they were saying is that they're struggling in terms of their occupancy rates is low, but obviously you can't just now switch off the geyser in a hotel. So you have to keep things running. And so we looked at their portfolio of hotels, and simple things like the design of the hotel, if you have the core with the laundry area, simple things like that, like the laundry room and how much you need to do linen. Is it better to buy more linen and do less washing? Like, it's really simple things that one can apply that would be able to decrease their operational expenses. So there's a lot of potential. We did that. It was a project we did 2 years ago.
and that was in Nairobi. So there's a lot in terms of greening hotels and hospitality, and that can be a differentiator. I mean, I will just say that Accor, for instance, has got Planet 21, which is a sustainability program. So it's a differentiator.
Excellent. Great. So I'm not going to leave you out of the conversation, Nnema, because I know it's drifted a lot to hospitality. But what I'm going to do is I'm going to put some questions out there. But before we do, Nnema, I'm first going to ask you a question. The audience out there, do we have a mic runner? Do we have a mic runner? Okay, excellent. So in the meantime, in the audience, if you've got a question, if you want to direct it at any one of the panelists over here, please think about that now. And obviously mention your name, company, question. But so Nnema, we drifted a little bit to hospitality. You don't invest in hospitality.
Yeah, that's okay. But I mean, I think the conversation about green and sustainability was also very applicable to us because, we are developing properties with the objective of hitting at least a 4-star green rating.
Okay, fantastic. Well, that's a good goal. What are your greatest challenges? I mean, in terms of doing business and financing in Africa? Where are you bumping the head? And what are you doing to overcome it? Maybe you want to share. I know it's maybe some war stories over here, but it's not easy, I'm sure. But and you're very selective, and it sounds that you're very targeted in terms of your area and obviously your categories and that kind of stuff. Maybe share some of those challenges that in terms of the financing of your
Yeah, to be honest, I don't think there's any investor that has explored beyond South African borders that hasn't earned like war stripes. We've all earned our badges. It's been brutal, I would say. And people read the headlines. You see from time to time South African investors exiting the African market. I would say about 20 years ago, South African investors decided to explore beyond the borders to look at opportunities for developing and owning property outside of the South African borders. There was a search for yield, there was a search for dollar-denominated rents, and there was the interest in piggybacking on that growth that was occurring in the rest of the continent. Since then, a lot of things have changed. I would say that the learnings have come, in significant amounts. So, case in point, you have the Atterbury attack hype announcement that they were selling their portfolio of assets on the rest of the continent to the tune of about $600 million. You have R&B Westport that has exited. They're just a number of investors. I mean, even ourselves were scaled back and pulled back from the West African region. Issues relating to the market not necessarily panning out, as was mentioned. Rents that were underwritten over the past 2 to 4 years have not panned out. There have been issues with regard to obtaining land, and that being a very long drawn-out process, and land coming in at significantly higher than what was underwritten or expected. There have been issues with lack of capital. So whether it's on the debt side in terms of finding banks that are willing to finance development projects on the continent, where A, they might not have a footprint, or they might not have the experience, or they've just had very bad experiences in those markets. That's one side of the equation. The other side is raising equity or finding the equity investors that are willing to invest. South African investors over the past couple of years have shifted their views and their sights to offshore markets, Central European markets. I think in 2018, $4.8 billion of capital was invested by South African investors in offshore markets, mostly in Europe. This is 4 times the amount of money that was invested in South Africa. Only 1% of the capital that these investors have is invested in Africa. So finding that equity has been extremely challenging, if not impossible. But on the flip side, you do have other investors like Investec, Growth Point, that joint venture. They were able to raise a little bit.
Grit is a big investment.
Exactly, and Grit, yes.
Yeah.
Growth Point raised $212 million, which they probably would have fully deployed by the end of this year. Grit, exactly, as an investor with over $700 million of assets under management, and they were also able to list on the London Stock Exchange and raise capital from there. So there has been some interest from outside global investors and a few South African investors, but it has been very limited and very difficult to find that capital. On the project side, the difficulty I mentioned in terms of securing land, clean title, the difficulty of getting tenants in your building. So a lot of the markets that we look at, the concept of pre-let does not exist. So whereas in South Africa, you have your land, you aggregate your professional team, design, and find pre-lets of 70% of GLA, and then get debt, etc., and build. That doesn't really happen in the rest of the continent. Partly because tenants have been scarred in the past. They've seen developers come in and say they're going to build these amazing projects, and they sign up and nothing comes to fruition. But also the culture is that they want to see the building pretty much finished, or at least under construction before they sign up. And so coming to terms with those markets and then trying to navigate those markets and change them. So whereas in South Africa we would be looking for 7% of GLA in pre-lets, in those markets, we've settled on 60% pre-lets. But whereas we know the limitations of the market and the inability to get the types of pre-lets or offtake that we would look for here in South Africa, we know the risks of just blowing it all to the wind. We have examples in Ghana and Nigeria where buildings opened at 40% occupancy, and it took years. Some of those buildings are still not at stabilized occupancy. So these are learnings and experiences that we've seen, and challenges in the markets. The challenge related to pre-lets has also been with regard to the tenants. So we've seen South African retail tenants who previously were the larger occupiers of space, at least in West Africa, pull back. Woolworths, Pick n Pay, no longer continuing on those expansion strategies. ShopRite still, has maintained a strong presence and is in fact growing in East Africa now that Nnema has gone under. But there has been that challenge of finding those tenants to occupy spaces in the retail space. South African retailers, a lot of them are focusing on fixing things at home. South African consumer is under a lot of pressure, and so we've seen a lot of retailers in South Africa shuttering or going into business rescue. So a lot of efforts has been focused on fixing things back at home as opposed to expansion plans outside. But on the flip side, we have seen some new entrants coming in from Europe and Asia. So the likes of Carrefour that have grown rapidly in East Africa. They set foot in East Africa, established the first store through the MEF franchise out of Dubai in 2016. And now they have 7 stores in Kenya and 3 in Uganda. Carrefour is working directly with CFA out of France in the West African Francophone markets, and they've seen some level of growth, though not as rapid as they initially anticipated. So we do have the likes of Carrefour, we have the likes of LC White Kiki out of Turkey, we have the likes of other Asian and European tenants that are looking for opportunities to explore and expand in Africa. However, there is the challenge that a lot of these retailers come in first to South Africa, and the South African retail market is not that buoyant, so it has kind of stymied their expansion plans in the rest of the continent.
Great, excellent. Okay, so I'm now going to put questions to the floor, and if you could just raise your hand, and then if you could just stand and mention your name, company, and then who your question is directed to. So anybody have some questions? We've got a question here from the front. If you could give your name, sir, directed to who you would like to answer the question.
Thank you. Name is Kelly Kalumba from Green Core Architects in Lusaka, Zambia. Just wanted to find out from Nnema and I think the lady from Accor. Sorry, it's 2 people. Just wanted to find out, Zambia is quite endowed with a lot of water resources, lots of rivers and lakes, and hospitality that's starting to happen in those areas. Do you have any appetite to try and invest in Zambia and perhaps on the hospitality side, the hotels from the Accor group? Thank you.
Okay, so let's start with Nnema and then we get to you, Kim. Or you want to start? Yeah. No, you just, Kim, let's you kick off.
I think we have an appetite for Lusaka for sure. I'm not sure at the moment from an investment perspective. I mean, I, as representing Accor Hotels, the operator, am not in the position to make an investment. But I know that from Casada's perspective, at the moment they've identified 10 key cities throughout Sub-Saharan Africa that they are first earmarking for investments. And I think the main reason behind that, for example, also why we would probably invest in South Africa, Johannesburg, and Cape Town first, is that the South African market in terms of travel and tourism in the Sub-Saharan African region is very important, very dominant. I mean, there's a lot of travel out of South Africa. I mean, even if you look from the retail perspective, there's a lot of South African retailers that are in some of the Sub-Saharan African key cities. So we need to first build our exposure and our brand equity in some of the key markets before we can stream out into some of the other markets. So at this stage, from an investment perspective, Lusaka is not yet on our horizon, but from a management perspective or franchise perspective, certainly. I've been to Lusaka. We've looked at projects, but I think Lusaka at the moment, as you alluded earlier, there's a lot of hospitality product coming into the market, and I think there's going to be in the short term a form of oversupply, similar as what we experienced during the World Cup, and that needs to be absorbed before there's space for more new development. Conversions, yes. So takeover of existing assets is certainly something we would look at.
Would you finance in those markets?
So, well, strategically, the Africa Development Fund excluded the Southern African countries, and that was primarily because of conflicts of interest. We had another group that was managing assets for Liberty's property portfolio, and they had some presence in Zambia, and we were trying to prevent that overlap. That portfolio has now been spun off, as many of you may know, into the Liberty 2 Degrees REIT. But with regard to Zambia as a market that we would look at, I do know that the Southern African portfolio had looked at other opportunities within Zambia, but then again, that was during the whole, or right up the commodities bust and the cost of copper kind of tanked, and the economy was just not that robust in terms of the diversification of the economy and the ample demand for additional retail space in Lusaka. So it was just one of those markets that we were not as comfortable with in terms of the volume, the robustness, and the ability for it to weather additional economic cycles and economic storms. So one positive thing that I would say for economies like Uganda and Kenya, while they are smaller than economies like, say, South Africa or Nigeria, they're less dependent on commodities, and so less dependent on that boom-bust cycle. And we've seen over the past 10, 20 years that GDP has been relatively stable and growing, unlike what we've seen in a lot of those commodities-dependent economies.
Great, thank you. No more questions? Yes, there's one right at the back over there, right at the back. If you could just move. Right. Kim, I think it's for you. All right.
Hi, it's Andrew from Radisson again. This is a question to the STANLIB. Just why have you excluded hotel real estate as an investment class in the geographies you're working in?
Why have you excluded
hotel real estate? If I look at the debt to equity ratios of 50-50 is exactly in line with what we would look at. You're not able to get the pre-lets beforehand, so you're opening buildings with 40% sort of occupancies. Hotels in those markets obviously perform better than that. We trade in foreign currency, so we're actually charging in dollars, earning our income in dollars, versus the retailers, which you're charging your rent in dollars, but you're actually trading in local currency. I'm just interested why, as an asset class, it hasn't really been looked at in more detail.
Do you have an answer?
Okay, yeah, sure.
Tough one.
So one point of correction, in terms of the pre-lets, though, we have stuck with requiring pre-lets. So depending on the market, we're looking at 60% pre-let before we put in substantial equity. And then, of course, the lender requires pre-lets, and we've seen lender requirements of about 70%, because a lot of those lenders were burnt by those buildings that opened at 40% occupancy. So no, we're not throwing caution to the wind and just going ahead and building without pre-lets. We are requiring those. As to why we haven't deployed capital in hospitality, one of the reasons is, STANLIB as an asset manager and as a wholly owned subsidiary of Liberty, an insurance company, is a little bit conservative. And the hotel industry and the lack of a head lease has been a challenge for us. In addition to the fact that our heritage comes from 40 plus years that Liberty has had developing trophy retail assets in South Africa, starting with Sandton, Nelson, and elsewhere. So we have leveraged that history and that experience in retail and office and taken that out to the continent, as opposed to exploring the rest of the continent in a sector that we're not that familiar with.
Oh, interesting. Yesterday at Sandton City, I bumped into the board. Amelia Beats with the board. We should have posed that question to them there. But I think really great question over there.
And I'll just add to that, I mean, while the Liberty portfolio, Liberty 2 Degrees, has had exposure in the hotel sector in South Africa, it's always been in partnership with an experienced hotel developer and investor. So we're not going out on our own. Exploring that sector, and certainly not doing it in the rest of the continent.
Great. One more question. I think we've got time for another one. Has everybody gone dead quiet? Anybody? Yes, we've got one over here. Just take that question. Thank you.
Hello, good afternoon. My name is Hassan Bouhadi from Mapei Construction Chemicals. I would like to ask the panel about the thermal insulation, which is really coming, to the green, targets. But it's also, I think, a target for the countries and the authorities to really try and use energy in the most efficient way. So from an investor, at one point, I mean, do you actually put some criteria regarding energy savings when you actually invest in real estate? And also from a designer point of view, do you actually have some sort of guidelines? And from a management point of view also, do you actually have within Accor these, I would say, energy saving guidelines? Thank you.
Great.
Okay.
Vere, you're going to give it a go? Yeah.
I'll just start just from a designer's perspective. So what we've just found is that in certain countries, thermal insulation is actually legislated. So in South Africa, we do have legislation on the building performance of your facades and your building envelope. So that is legislated, and because of that, that's why the thermal insulation industry in South Africa has grown. It's gotten better in terms of even ODP and the performance, and looking at things like double glazing and all of those other things. In other African countries, though, because I've traveled to quite a bit where we had to help them figure out what is their minimum performance, there are no standards that legislated. And so when there are no standards, they either just default to British standards or to something else like ASME or whatever. They'll default to other standards, or they just won't do it at all because it's not a requirement. So it's almost one of those things where unless a property developer or property owner knows about green performance and finds a way to put it into their life cycle costing, because a lot of the times they do costing only for buildings, like the building stage, but they don't go into how is it actually going to operate. So unless they actually do those calculations and ask their team to make sure and report back on that, most investors, from what I've seen, don't actually include the need for green, because not enough of them know about it. I will say for STANLIB, for instance, we actually worked with STANLIB in Uganda, where it was developing the Green Star tool for Uganda. And because they have a Green Star tool and a very active Green Building Council, that's when you start seeing the need for green in design, only if there's a really active Green Building Council. And so just to add to that, the Green Building Councils that are active across Africa where you will find these requirements are Kenya, it's Rwanda, Uganda, it's Ghana and South Africa, and then Mozambique is coming, and so is Ivory Coast, just in terms of getting a Green Building Council active. Yeah.
Excellent. Do you want to elaborate on that, Peter?
So I just want to pick up just from a design perspective as well. You know, from an installation perspective, I mean, you can talk from the green and the XAs, SABS 10400 XA, which is something as designers we have to do locally. But I agree with you. You know, working across the continent, there's an eco-consciousness filtering from developers, and the developers that we're working with also are in country, so they're local from the different countries that we're working in. But they have an idea of what they want to do, but it might not necessarily mean a rating. But they know that water is scarce, electricity is scarce, there is a life cycle process here, because at the end of the day you've got to pay for it down the line. But you start working on it, and it goes back to the hotels as well, where although they're brand standards, you know, we're clear when we design hotels, there's a brand standard that we work around. But you know, what I'm trying to get at is the type of specifications that we use, whether it's a low flow restrictor or a low flush WC or whatever it might be, it's built in mind that when we design with this intent. So it doesn't have to go to a rating. I mean, you can probably back that up, you know, but it's a consciousness that a lot of developers are coming out with, and I see that is a trend, and it goes back to what you're saying about the council. So the Green Star perpetuating into Kenya, Uganda, Mozambique, etc. So the Green Star of South Africa came from Australia, now it's going into Africa. There's also LEED and Edge. I understand Edge has been flouted quite nicely now, where it's a lot cheaper. You know, it's an easier tool to use. You can go online, you can get it accreditation quite quickly, and you can also use it as a marketing tool. But it doesn't have to be accredited. But I think what I'm, you know, the theme here is consciousness. You know, there's a eco-consciousness. Whether it's in the hotel industry, you know, retail, how your life cycle projects work, specifications that designers, what we do, what we specify. And I think that's just an inbred thing that's coming through now, and it's very much, I can see that going forward.
Yes, so just to add in here, it's an eco-consciousness, and as mentioned, our project in Uganda was, or is, the first green Star rated project in Uganda. And because of that, there were no standards in place. We had to actually contextualize the Green Star from South Africa to Uganda, and we created basically the system there. So there is an eco-consciousness, but there is also the commercial consciousness. And going green makes commercial sense. So what we find, or what we've seen in the rest of the developed world, is that Green Star rated or LEED certified projects or buildings actually have lower cap rates at exit. So they sell it at a premium to non-rated buildings. And that's only going to increase. I mean, it's going to reach a point. I mean, you have corporate tenants that are demanding that on the continent. They are demanding, you know, that their space is Green Star rated or LEED certified. For us as property owners, it also makes sense because it lowers the cost of operation, and we can actually pass those savings on to the tenants, or actually their overall cost of occupancy is lower because their occupancy costs, their water, electricity, etc. is cheaper. We're also finding that, of course, in a lot of these markets, these services are just not available on a regular basis. So if you look at markets like in Nigeria or Accor, where they've had issues with power supply, water supply, I mean, it just makes sense for your building to have its own independent power supply, a solar system, water recycling, etc. So commercially, it makes sense for us as property owners.
Great. What I'm going to do is going to ask for parting shots. Sorry, we've run out of time, but what I will give you the opportunity when we do the passing shots, just starting off with Kim, maybe just your summation in terms of the trends and the shifts going forward. What is your quick parting shot in closure of this discussion? Quick, in terms of trends, the one-liner.
I think that what has been touched upon before, I think we're definitely shifting towards more efficiencies within our hotel developments, making multiple uses of spaces rather than just having single use, similar as, you know, the breakfast room is no longer just the breakfast room, but you use it for multiple different functionalities, and certainly further towards a lifestyle approach in the hospitality segment.
Excellent. Great. Thanks, Byrd.
I think that's probably the theme as well, just even from a green engineering perspective, is efficiencies. So less energy use and integrating that into design, less water, less waste. And also, like it's similar to what Nnema had said as well, it actually came out of a need in a sense, because the more self-sufficient you are, the better. So that's what we're seeing. And then just in terms of what you were talking about, green building councils and consciousness, I'd say that the drivers of green are the green building councils. Recommendation to any product suppliers here is then you sponsor a green building council within a country that you're trying to enter, because that's what happened. I mean, there's certain brands that I won't mention, but they're the ones who, if you want installations to be a priority, then you sponsor the green building council because installation is good for a building. And they're the ones who normally come into the market and they'll push consciousness. And then once property owners realize that, then that's when they say they start asking their professional teams to be more green. So it's just trying to figure out what those drivers are.
Great. Tim?
Okay, so mine is definitely, as I picked up, it's eco-consciousness, and that just goes back to basic design principles. It doesn't even have to be the low flow restricted. It's good orientation of a building. It's how you overhangs, shading devices, bringing in natural light. So that for me is something that I think is very important. And as I said earlier, it's been perpetuated into developers and investors' minds that this is the way we need to go. I mean, that goes back to the 2015 Paris agreement,
yes,
which is very much a mindset change. And I think I see that perpetuating into the continent, or the subcontinent regions. The other item is mixed use, as I mentioned, so I'm going to pick up on that just quickly. So because of land costs, I see that as an incredible opportunity to develop things where hotels, retail anchor hotels can opportunity to come in. There's counter-cyclical opportunities with parking, etc., etc. So these type of things, creating a sense of community, a different node, developing a node. This is a theme that is coming through. And then the last one being retail, as I picked up, it's about engaging the customer. I think that's an international trend, which I'm seeing in our designs on the continent. So it's a beneficiary of what's happening around the world coming through. And I can see what people, and again, it's in-country developers and investors that we're working for, not only private equity funds like yourself, private property funds, etc. And they are wanting these things. So it's definitely something, a theme that is picking up in our designs and going forward.
Great stuff. Nnema, do you hold on to that?
So, in summary, the theme that we see, at least from the finance investment side, is that we've gone through a period of the recession, a slump. Prior to that period was a heyday where everything was working. And I think what we've learned and what we're seeing is that the recession has taught that this is a property market like any other property market in the world. We have our booms and busts. And a lot of the countries that we were looking at and investing in had never seen a real estate bust. So it's almost like a wake-up call to reality that, there needs to be a lot more rigor in terms of the underwriting process, in terms of your due diligence before going into markets or specific projects. But that rigor needs to be there. There's also the understanding that we need to actually look at homegrown. That's homegrown capital, homegrown talent, homegrown tenants, and develop that. And a lot of that development is already occurring right now. And specifically in terms of the homegrown capital, we see the expansion of pension funds now investing in real estate, increasing their allocation to real estate. So we have pension funds in Ghana, Nigeria, Kenya, etc., investing into the real estate sector. So these areas of development will only help to buoy the real estate development sectors in these markets and somewhat shield them from the speculation that international investors or international tenants may have.
Great stuff. I'd like to thank our panelists. Can I think put your hands together for Kim from Accor, we've got Vere from Shaba, Tim from Bentel,